Good morning. This is Ken Long from Tortoise Capital Management with a review of the weekend trading report for March 1st, 2014. The market is in bullish normal conditions on an annual basis using weekly RSI 14. We're at the high end of neutral at a score of 69 out of 100. At 70, this moves into overbought conditions on that annual basis. The 10-day NDX measures the short-term market condition, and we are slightly overbought at a score of 81 out of 100. Looking at the market mosaic, the price relative to the 200-day moving average is at 8.45%, almost 6.5% away from sideways condition. Slope of the 50-day moving average has improved to white bullish at a positive 0.44%. ADX 14, measure of strength of trend, is in the low neutral range at 17.5. ATR percentage has dropped down underneath 1% at 0.88%. The risk index is the 30-period moving average of the VIX divided by the 10-period. That reading comes in at 1.08, which puts us into risk-on conditions. 1.0 is the threshold between risk-on and risk-off. That means holding riskier assets is favored. The risk Z is when we take that score of 1.08 and compare it to the last 5,000 trading days, find the standard deviation and the Z score, and that puts us at 0.91. You can see on this graphic the last 90 days of this histogram that we have completed a really nice swing trade move in XIV during this condition, and the risk index or the risk Z is showing some signs of rolling over, which would indicate a potential rise in short-term volatility. So we'll be careful on that swing trade and be prepared for a shift in the volatility regime. Blended monthly rebalancing was updated this week. If you waited until 1 March, the current readings are the current holdings would be the ETF 13, technology, U.S. real estate, and U.S. small caps in the ETF 13. ETF 22 is technology, real estate, and then XLV is healthcare. And ETF 32, that's technology, healthcare, and then the commodity grains, agriculture ETF. The current leaders, you'll notice here, we've added the Dow 30, the ETF 200, and the ETF MEX categories, finding the top holdings in those portfolios. And ETF 2, theoretical exposure is at 70%. The model portfolio will be at 100% exposed. We're making some trade ups this week in the model portfolio, getting a little more diversification and rotating to some slightly stronger positions. Just a quick look at the blended monthly rebalancing portfolios, ETF 13. You can see mostly on buy signals, only Japan, emerging markets, and Latin America on cash. In the ETF 32, again, about 80% of them are on buy signals, and it's really just the globals that are on cash positions. You can see just how much pain Brazil has been in, down 13.5% over the last 3 months, and basically flat for the last 6 months. And then ETF Max, these are the top 50 based on the blended percentage. The top 50 out of the 1,300 ETF database, the ETF Master. Coffee at the very top of the stack. This is one of the reasons that we like to look at that very broad ETF stack, because of the possibility of finding moments of extraordinary momentum and outperformance among these key leaders. And you can see coffee is up almost 70% over the last 3 months. Pretty remarkable move. Ones that are cooling off we would see as white in the 3-month column and green in the 6-month column. As an example, Greece is uh, down to up 9.5% over the last 3 months, and that's not an exceptional return based on the other candidates, whereas it's been still among the leaders in the green here with the 6-month percentage. Conversely, those that are green and white are ones that have the possibility uh, for catching them early in their expansion, and those would be the Gulf States Index, the SOFS Total Return Subindex, natural gas, and even uranium, which is uh, exceptionally strong on the 3-month and below average on the 6 month. So that may be an early entry. There may still be some room for that to grow. Market health check. The last over the last 4 months, the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance, and which, if the market fails here, would become targets on the downside. This blue line was once purple. It represented the swing high. We've now moved up into the green zone where I have a bias of being long by default. And that's accompanied by this 10-period regression line that has become very strong. Even the 30 has rolled up to become positive now. This had been negative, exceptionally negative during this pullback 20 and 30 days ago. But now the 10, the 30, and the 90-period regression line are all still pointing up. We're free and clear above the previous resistance. No resistance overhead. Price is in the middle of the floodplain. It has left the river, which is this darker blue shaded area. That's the 30-period Bollinger Band plus or minus 1. The floodplain is the lighter blue shaded area. That's the 30-period Bollinger Band plus or minus 2. Still room to go. 190 is the next target on the upside. You can see this sine wave looking curve here is the slope of that 30-period regression line. You can see at the end of last week it crossed over back into the positive side, and it is currently at about 0.176. That's still not as extraordinarily steep up as we've seen before. It really takes a reading of about 0.4 in terms of steepness for that 30 period to get well overcooked, well overheated. So there's still room on the upside, just based on technical analysis. We've been overbought now for 15 days. It can stay overbought for long periods of time. If we do see some weakness here on the basis of global news, say in Russia and Ukraine, we'd be looking for support at the edge of the river, at the southern edge of the dragon, which would be the 10-period regression line and the 30-period mean. And then at the Bollinger Band mean. If this support level here at 183 fails, though, then we'd be looking at 181 and then 177 on the downside. In my view, the nervousness over Russia could be the trigger for that a change in the volatility regime we talked about earlier. So we'll keep our powder dry. Looking at the ETF2 regional report, 7 out of the 10 global regional indexes are on a buy signal, 3 are on the cash. That puts the theoretical model at 70% invested, 30% cash. There's a dead heat between SPY at 50 and 50 at on the Euro-Asia blend. Europe is actually in charge here at a score of 52, while Asia less Japan is lagging at 46. So we have the S&P and the global environment about balanced right now. Inside the U.S., the strength is in the technology, then mid caps, then small caps, Then the large caps. The two strongest sectors in the world are U.S. tech and Europe at 53 and 52 respectively. And the two weakest sectors are Latin America at 36 and emerging markets at 41. Inside the U.S. sector spiders, it's still healthcare, free and clear by a long run, materials, then technology. World market model, all of the U.S. is above average except the Dow. Asia and less Japan, and Japan are both below average. The Asian countries that are making stronger moves right now: China, India, Vietnam, and then Indonesia. Everything Europe is above average. Spain and Belgium exceptionally strong. Inside the business sectors, it's basically a dead heat between the U.S. and the global counterparts. Latin American emerging markets just really suffering here. The top 30 in the ETF2 database using that methodology of ranking. And this provides us similar insights as those found in the blended monthly rebalancing, but it's nice to cross-check. Wilder Hill Clean Energy, the Alpha Dex Gold Miners Semiconductors. These are green and white or green and yellow. That's a sign of potential early strength. You can see the top 10 dominated by natural gas and healthcare / pharmaceuticals. Looking at the Dow 30 through the same lens, Walt Disney has been exceptionally strong. We got a handful of weak ones down here: AT&T, Chevron, and Walmart at the bottom. DuPont could be an early leader here with green on strength and white on consistency. Just looking at volume and ATR percentage for the top 30 most liquid ETFs, to get a sense of what they can offer for intraday trading. The ones that are green are exceptionally volatile, so that'd be VIX and natural gas. Shifting to the daily report. No signals in channeling and overreaction. Got a couple patterns: 551W and JPM, that's JP Morgan, and McDonald's. And then in the auto framer, Cliff, Cisco, AT&T, JP Morgan, and Coca-Cola. Testing out better than 2 to 1 on the auto framer. Nothing on the RSI2. Here's our two patterns in 551W for JP Morgan and McDonald's. McDonald's has the benefit of being a doji as well. And AT&T testing out at 2 to 1 on the auto framer reward to risk trade frame. Among the ETFs, silver offering channeling and overreaction. Nothing testing out better than 2 to 1. Nothing on the RSI2. And just 4 targets here in the auto framer. I've added this extra column so you can see what the source of these are. Cliffs Natural Resources CLF at 3.42 to 1 is the source number is 6, meaning that's just one of my favorites to trade. EWW Mexico, which comes in at 2.76, is category 5, and it's one of the ETF 200, and so on. And that's everything I want to cover for this weekend's report. And keep your risk measured and your powder dry. We're going to have a special presentation tonight from John Gowing, who's been forward trading the weekly RLCO framework with some very interesting results. So we look forward to seeing you online. And in the chat room, don't forget to check out our Frog and RLCO research projects. We'll get a chance to work with IITM's trade simulator for free. That's definitely worth checking out. You can really contribute to the community of research practice if you do that. And then also a link on my webpage to our Kansas City Research Weekend and live trading workshop. Still some slots open for that one if you're interested in coming out to Kansas City and putting this stuff into practice in a live trading group. So, Ken Long from Tortoise Capital. Keep your powder dry and risk measured.